When inflation surges, the spotlight invariably turns to central banks. We hear about interest rate hikes, urgent policy meetings, and critical announcements. There's a pervasive belief, often unspoken, that central banks possess the ultimate lever to fix inflation, provided they act with sufficient resolve. But is this expectation truly aligned with reality? In practice, central banks operate within very real, often misunderstood, constraints. They exert direct influence over specific segments of the economy, an indirect pull on others, and absolutely no control over many fundamental drivers of economic activity. If the complexities of inflation policy have ever left you feeling confused, frustrated, or simply disappointed, this deep dive is designed to illuminate precisely what central banks can and cannot control. We aim to provide a clearer, more nuanced understanding of their role in our intricate global economy. Before we delve deeper, let's establish a clear understanding of this video's purpose. This analysis is not intended as a critique of central banks or their personnel. It is not an attempt to predict future policy decisions, nor does it promote any particular political or economic agenda. Our objective is purely educational and analytical. By the conclusion of this discussion, you will possess a more robust framework for understanding the intended scope of central bank influence. You will grasp the significant factors that lie beyond their reach, and crucially, you will see how recognizing this distinction empowers you to interpret inflation-related headlines and public expectations with greater accuracy and a calmer perspective. Our goal is to foster clarity and informed understanding, not to pass judgment. Central banks occupy a pivotal position within the architecture of modern monetary systems. Their functions are foundational to economic stability and growth, making them natural focal points during periods of economic stress, especially inflation. They are responsible for setting short-term interest rates, managing the overall liquidity within the financial system, and acting as the critical lender of last resort during crises. Furthermore, central banks frequently signal their economic priorities and outlook, guiding market expectations. This high level of visibility, however, often leads to an overestimation of their actual power. While they undeniably influence financial conditions, this influence does not equate to omnipotence over every economic outcome. Understanding this crucial distinction is paramount for accurate economic analysis and financial literacy. Central banks, such as the Federal Reserve in the United States or the European Central Bank, primarily influence the cost and availability of money. They do this by adjusting their benchmark policy rates, which then ripple through the entire financial system. This mechanism affects everything from consumer loans to corporate investments. Their role in managing liquidity involves ensuring there's enough money circulating to facilitate transactions without causing excessive inflation or deflation. This is often achieved through open market operations, buying or selling government securities. These actions directly impact the reserves held by commercial banks. As lenders of last resort, central banks provide emergency funding to solvent financial institutions facing temporary liquidity shortages. This critical function prevents systemic financial crises and maintains confidence in the banking system. It's a safety net that underpins financial stability. Through their public statements, economic forecasts, and policy decisions, central banks also communicate their stance on the economy. This forward guidance helps shape market expectations about future interest rates and inflation, influencing long-term investment and spending decisions. Their credibility is a powerful tool. However, despite these profound responsibilities, the public often conflates their visibility with an ability to control all economic variables. This misconception can lead to unrealistic expectations and frustration when policy actions don't yield immediate or comprehensive results. It's vital to differentiate between influence and absolute control. Central banks possess direct influence over a narrow, yet profoundly important, set of economic levers. Their primary tools allow them to adjust short-term interest rates, which then cascade through the financial system to influence broader borrowing costs. This direct action significantly affects financial market conditions, shaping the environment for investment and consumption. Crucially, central banks can signal their unwavering commitment to price stability, a cornerstone of their mandate. These tools collectively shape the availability of credit, influence investment behavior across sectors, and calibrate the overall risk appetite within the economy. In essence, central banks meticulously craft the financial landscape in which inflation either takes root or is contained. However, it is vital to reiterate, influence is a powerful force, but it is fundamentally distinct from absolute control. When a central bank raises its policy rate, it directly increases the cost for commercial banks to borrow money overnight. This higher cost is then passed on to consumers and businesses in the form of higher interest rates on loans, mortgages, and credit cards. This mechanism is known as the monetary policy transmission channel. By making borrowing more expensive, central banks aim to cool down an overheating economy. Higher borrowing costs discourage new investments by businesses and reduce consumer spending on big-ticket items like homes and cars. This reduction in aggregate demand helps to alleviate demand-pull inflation pressures. Conversely, lowering interest rates makes borrowing cheaper, stimulating economic activity. This encourages businesses to invest and expand, and consumers to spend, thereby boosting demand during economic downturns. These adjustments are powerful in managing the business cycle. The impact extends to financial markets, where interest rate changes can affect bond yields, stock valuations, and currency exchange rates. Higher rates can attract foreign capital, strengthening the domestic currency, which in turn can make imports cheaper and exports more expensive. This complex interplay influences trade balances and inflation. Central banks also use communication, or forward guidance, to manage expectations. By clearly articulating their inflation targets and their commitment to achieving them, they aim to anchor public and market beliefs about future price levels. This credibility is essential, as expectations themselves can become a self-fulfilling prophecy for inflation. These actions collectively shape the financial environment, influencing decisions made by millions of economic agents. They can make credit abundant or scarce, encourage or discourage risk-taking, and ultimately steer the economy towards or away from inflationary pressures. Yet, even with these potent tools, their reach has definite boundaries. While central banks wield significant influence over monetary conditions, a vast array of critical inflation drivers lie entirely outside their authority and operational scope. These are often real economy factors that monetary policy simply cannot address directly. Central banks cannot, for instance, manufacture goods, construct housing, or resolve intricate global supply bottlenecks. They have no direct control over the intricate web of global supply chains, which can be disrupted by anything from pandemics to geopolitical conflicts. Nor can they dictate energy production levels or mitigate the impact of sudden geopolitical disruptions that send commodity prices soaring. Weather-related shocks, which devastate agricultural output or disrupt transportation, are similarly beyond their purview. Furthermore, structural issues like chronic housing supply constraints, driven by local zoning laws and construction costs, or long-term demographic trends affecting labor supply and demand, are fundamentally non-monetary problems. When inflation is primarily driven by these real-world, structural forces, the effectiveness of monetary policy becomes inherently limited. This fundamental disconnect often explains why central bank actions, despite their best intentions, can sometimes feel frustratingly disconnected from the lived economic experiences of ordinary citizens and businesses. Consider the impact of global supply chains. A central bank cannot compel factories in other countries to produce more goods, nor can it clear congested shipping ports. When events like the COVID-19 pandemic or the Suez Canal blockage disrupt the flow of goods, leading to shortages and higher prices, these are supply-side shocks. Monetary policy, which primarily targets demand, is ill-suited to resolve such issues. Energy production is another prime example. Central banks cannot drill for oil, build new power plants, or negotiate international energy agreements. When geopolitical tensions, like conflicts in major oil-producing regions, lead to spikes in crude oil prices, this directly translates into higher fuel and utility costs for consumers and businesses. Raising interest rates might cool demand, but it won't magically increase the supply of oil. Geopolitical disruptions, such as trade wars or international sanctions, can also significantly impact inflation. These events can restrict the availability of key raw materials, impose tariffs, or create uncertainty that deters investment. These are political and diplomatic challenges, not monetary ones, and central banks have no direct instruments to resolve them. Weather-related shocks, increasingly frequent due to climate change, can devastate agricultural harvests, leading to higher food prices. A severe drought or flood can wipe out crops, creating scarcity. While a central bank can influence the cost of borrowing for farmers, it cannot make it rain or prevent a natural disaster. Housing supply constraints are often local and regulatory in nature. Zoning restrictions, lengthy permitting processes, and a shortage of skilled construction labor contribute to rising housing costs. These are structural issues that require policy solutions at municipal or national levels, such not interest rate adjustments. Finally, demographic trends, such as an aging population leading to a shrinking workforce or shifts in migration patterns, have profound long-term effects on labor markets and productivity. These are slow-moving, powerful forces that influence wage growth and overall economic capacity, but they are entirely outside the scope of monetary policy. Central banks cannot alter birth rates or immigration policies. In these scenarios, applying monetary policy tools, particularly aggressive rate hikes, to combat supply-side inflation can be akin to using a hammer to fix a screw. It might eventually reduce overall demand enough to bring prices down, but often at the cost of significant economic slowdown or even recession, without directly addressing the root cause of the inflation. History consistently reinforces the inherent limits of central bank power. The inflationary period of the 1970s serves as a stark reminder. During that decade, central banks globally eventually resorted to aggressive monetary tightening, pushing interest rates to unprecedented levels. While inflation eventually receded, it did so only after a prolonged period of significant economic adjustment, including multiple recessions and high unemployment. The cost of bringing inflation under control was substantial, highlighting the blunt nature of monetary policy against entrenched price pressures. In subsequent decades, central banks demonstrated greater success in managing inflation primarily driven by excess demand. When robust economic growth leads to too much money chasing too few goods, monetary policy is highly effective in cooling demand. However, they have consistently struggled when inflation originates from supply-side shocks or structural impediments. Across diverse countries and varied time periods, a consistent pattern emerges. Central banks are most potent and effective when inflation is a symptom of overheating demand, but their efficacy wanes considerably when inflation is rooted in real-world constraints, resource scarcity, or external shocks. This historical lesson is crucial for understanding current challenges. The 1970s stagflation era, characterized by high inflation and high unemployment, was particularly challenging for central banks. It demonstrated that simply raising interest rates might curb demand, but it couldn't magically increase oil supply or improve labor productivity. The policy response was painful, leading to a deep recession in the early 1980s, but it ultimately re-anchored inflation expectations. In contrast, periods of demand-driven inflation, such as during economic booms, are more straightforward for central banks. By raising interest rates, they can effectively reduce aggregate demand, bringing it back in line with the economy's productive capacity. This is the classic textbook scenario where monetary policy works as intended. However, when inflation stems from factors like global commodity price spikes, natural disasters affecting food supply, or geopolitical conflicts disrupting trade routes, central banks face a dilemma. Raising interest rates in such scenarios might curb demand, but it doesn't solve the underlying supply shortage. In fact, it can exacerbate economic hardship by slowing growth and increasing unemployment without directly addressing the cost-push factors. For example, if a drought causes food prices to soar, raising interest rates won't make more food appear. It will only make it harder for people to afford the food that is available and for businesses to invest. This highlights the distinction between monetary phenomena and real economy phenomena. This historical perspective teaches us that monetary policy is a powerful tool, but it is not a panacea. Its effectiveness is highly contingent on the nature of the inflationary pressures. Policymakers and the public must recognize these historical patterns to set realistic expectations for what central banks can achieve in different economic environments. Ignoring these lessons can lead to misdiagnosis and ineffective policy responses. Beyond the mechanical adjustments of interest rates, one of the most potent, yet intangible, tools at a central bank's disposal is its communication strategy. By meticulously shaping public and market expectations, central banks can profoundly influence a range of critical economic behaviors. These include the dynamics of wage negotiations, the pricing decisions made by businesses, and the long-term investment strategies adopted by firms and individuals. However, the power of expectations is inherently fragile. If the public or financial markets begin to doubt a central bank's resolve or its actual ability to control inflation, the efficacy of its policy signals can rapidly diminish. This vulnerability explains why central bank communication often appears exceptionally cautious, meticulously measured, and frequently repetitive. They are not merely conveying information. They are actively managing confidence and credibility, which are as crucial to economic stability as any interest rate adjustment. Central bank communication, often referred to as forward guidance, aims to provide clarity about future policy intentions. This helps economic agents make more informed decisions, reducing uncertainty. For instance, if a central bank clearly signals its commitment to an inflation target, businesses are less likely to raise prices excessively, and workers are less likely to demand exorbitant wage increases, as they expect inflation to remain contained. This management of expectations is a delicate balancing act. If a central bank is perceived as being too dovish, too focused on growth, not enough on inflation, inflation expectations can become unanchored, leading to a self-fulfilling prophecy of higher prices. Conversely, if it's seen as too hawkish, too focused on inflation, potentially at the expense of growth, it can stifle economic activity unnecessarily. The credibility of a central bank is its most valuable asset. Once lost, it is incredibly difficult to regain. This is why central bankers often speak in carefully chosen, often technical, language and repeat key messages consistently. They are trying to build and maintain trust that they will act to achieve their mandate, typically price stability and maximum sustainable employment. For investors, understanding central bank communication is crucial for portfolio management. Signals about future interest rates can significantly impact bond yields, stock market valuations, and currency movements. For businesses, these signals influence decisions about capital expenditure, hiring, and pricing strategies. The challenge is that expectations are not always rational or easily controlled. Public sentiment, media narratives, and political pressures can all influence how central bank messages are received and interpreted. Therefore, central banks must not only formulate sound policies, but also communicate them effectively and consistently to manage this powerful, yet volatile, aspect of economic behavior. Another significant source of public frustration and misunderstanding regarding central bank action stems from the inherent timing discrepancies in monetary policy. Monetary policy operates with what economists term long and variable lags. This means that the effects of an interest rate change implemented today are not immediately felt across the economy. Instead, they unfold gradually over an extended period. For instance, a decision to raise interest rates will only slowly begin to affect borrowing costs for new loans and mortgages. This, in turn, influences consumer spending and business investment over several months, if not quarters. The full impact on pricing behavior and inflation expectations can take even longer, often extending over years. This substantial delay can create the perception that policy responses are ineffective or insufficient, even when they are diligently working their way through the economic system beneath the surface. Understanding this timing gap is crucial for tempering expectations and recognizing why immediate relief from inflation is a rare and unrealistic outcome. The transmission mechanism of monetary policy is complex and multifaceted. When a central bank raises its policy rate, commercial banks eventually adjust their lending rates. However, existing loans, especially fixed-rate mortgages, are not immediately affected. It takes time for new borrowing and refinancing to reflect the higher rates. Consumers and businesses also don't instantly change their spending and investment habits. Large capital projects by companies are planned months or years in advance, and consumer purchases of big-ticket items like cars or homes involve significant decision-making processes. These decisions are influenced by, but not solely dictated by, current interest rates. Furthermore, the wealth effect also plays a role. Higher interest rates can depress asset prices, like stocks and bonds, making individuals feel less wealthy and thus less inclined to spend. This effect also takes time to materialize and influence aggregate demand. The exchange rate channel also operates with a lag. Higher interest rates can strengthen a country's currency, making imports cheaper and exports more expensive. This can help reduce imported inflation, but the full impact on trade flows and domestic prices is not instantaneous. These lags are not uniform. They can vary depending on the economic environment, the size of the rate change, and the specific sector of the economy. This variability makes it challenging for central banks to precisely time their interventions and for the public to immediately connect policy actions with economic outcomes. The frustration arises because people expect immediate results, especially when facing rising costs of living. However, monetary policy is more like steering a supertanker than a speedboat. It changes direction slowly, and the effects are felt much later. Recognizing this inherent delay helps to manage expectations and appreciate the long-term strategic thinking required in central banking. To truly grasp the role of central banks, it's essential to adopt a more accurate and nuanced framework. Rather than viewing them as omnipotent commanders of the economy, it's more precise to understand them as guides of financial conditions. They influence the incentives within the economic system, but they do not dictate specific outcomes. Their role is fundamentally about managing complex trade-offs, not eliminating them entirely. Recognizing these inherent limits does not diminish the critical importance of central banks. On the contrary, it places their actions and decisions within a realistic and understandable context. This perspective allows for a more informed interpretation of economic news and policy debates, moving beyond simplistic narratives of success or failure. It fosters a deeper appreciation for the intricate challenges they face. Central banks operate within a complex adaptive system, not a simple machine. They can adjust the levers of interest rates and liquidity, but they cannot control human behavior, technological innovation, or geopolitical events. Their influence is primarily through the cost of capital and the availability of credit, which then shapes the decisions of millions of individuals and businesses. They influence incentives by making saving more attractive or borrowing more expensive. This nudges economic agents towards certain behaviors, but it doesn't force them. For example, higher interest rates might encourage some people to save more, but others might still choose to spend if their income is rising or they feel confident about the future. The management of trade-offs is central to their mandate. Often, central banks face a dilemma between controlling inflation and supporting economic growth and employment. Aggressively fighting inflation might lead to a recession, while prioritizing growth might allow inflation to spiral. There is no perfect solution, only difficult choices. This framework helps us understand why central banks often move cautiously. They are constantly weighing the potential benefits of an action against its potential costs and unintended consequences. Their decisions are based on economic models, data analysis, and a deep understanding of historical patterns, but also on an acknowledgement of uncertainty. By understanding that central banks guide rather than command, influence rather than dictate, and manage trade-offs rather than eliminate them, we gain a more sophisticated appreciation for their role. This perspective moves us away from simplistic blame or unrealistic expectations, fostering a more grounded and analytical approach to economic news. Embracing this more nuanced understanding fundamentally alters how we interpret inflation news and central bank policy announcements. It provides a crucial lens through which to comprehend why policy adjustments, even significant ones, do not instantly translate into lower prices at the grocery store or gas pump. It helps explain why inflation relief often feels uneven, impacting different sectors and demographics at varying rates. Furthermore, this perspective clarifies why central bank actions frequently appear cautious, measured, and incremental rather than swift and decisive. It replaces the common feelings of disappointment or frustration with a more grounded and informed perspective. Ultimately, recognizing the inherent limits of central bank power leads to more realistic expectations, fostering a calmer and more accurate assessment of economic realities. This understanding helps us appreciate the complexity of inflation. It's not a single phenomenon, but a confluence of demand-side pressures, supply-side shocks, and expectations. A central bank's tools are best suited for the demand side. When inflation is driven by global energy prices or supply chain disruptions, monetary policy can only indirectly address it, often by dampening overall demand, which has broader economic consequences. It explains why inflation relief can be uneven. For example, if housing costs are driven by local zoning laws and labor shortages, interest rate hikes might cool demand for new homes but won't solve the underlying supply problem, meaning housing inflation might persist longer than other categories. Different sectors respond differently to monetary policy. The cautious approach of central banks is a reflection of the long and variable lags of monetary policy and the significant risks of overshooting. Aggressive tightening could plunge an economy into a deep recession, while insufficient action could allow inflation to become entrenched. Central bankers must navigate this narrow path with prudence. This perspective also encourages us to look beyond just central bank actions when analyzing inflation. It prompts us to consider other factors like fiscal policy, global events, technological changes, and structural reforms. Inflation is a multifaceted problem requiring a multifaceted understanding. By replacing disappointment with perspective, we can engage with economic discussions more constructively. We can ask more informed questions, challenge simplistic narratives, and advocate for policies that address the root causes of inflation, whether they are monetary or non-monetary. This leads to a more sophisticated form of financial literacy and economic citizenship. Let's return to the fundamental insight that underpins our entire discussion. Central banks undeniably influence inflation, but it is crucial to recognize that they do not possess absolute control over it. Their primary role involves shaping financial conditions, meticulously managing expectations, and skillfully navigating the complex web of economic trade-offs. A clear understanding of what central banks can, and crucially, cannot do, empowers us to interpret inflation news and policy decisions with greater clarity and accuracy. This informed perspective allows us to move beyond simplistic assumptions of either guaranteed success or inevitable failure, fostering a more balanced and realistic view of their vital, yet constrained, role in the global economy. Please like this video if you have enjoyed it or received any benefit from it. Every one of your likes truly encourages us to continue creating helpful content. Thank you for watching and have a blessed day.